Hi, and welcome to my video series on how to get a mortgage. This is Nikki James. I'm with Opus Advisors, a division of Flagstar Bank. And welcome back. So today we are going to talk about what do lenders look at and detail on when they're looking at your mortgage application. Before we start, I should just note that my NMLS number is 293138. All right, so these are the 5 main things that we look at, and we're going to drill into each one of these: debt, income, collateral, that's the house, credit, and assets. All right, so digging in. When we're looking at debt, a lot of people are familiar with looking at credit scores, but we're actually looking at depth of credit. And so there's 2 things to go through here. So scores, most mortgages over 700 is sufficient. For the jumbo mortgages, which I talked about in my another video, the distinction between conforming and jumbo. Conforming are the smaller loans up to 510 nationally. Above that, they're called jumbo and non-conforming loans. They have different rules. So in the credit scoring, if you're above 720 in jumbo, you're pretty much okay. In conforming land, 680 is fine, and we even have loans that go lower than that. So that's the scores. Most people are familiar with that. You'll also have probably pulled your score off Credit Karma or somewhere like that. Just note that a mortgage credit report or credit score will be slightly worse. It'll be less because we have different scoring that goes into different calculations, because you're asking to borrow, potentially $500,000 or $1 million versus, $200 on an Amazon card or something. So little difference there. A couple of notes here. Basically, it's better for you when we're looking at credit scores to have a better credit score if you have less than 1/3 of the available credit on each card extended. So if you have $3,000 worth of credit debt, for example, you're better off having $1,000 on 3 cards that have a $3,000 limit than $3,000 on 1 card that has a $3,000 limit, because they're looking at the utilization of credit. How much of your available credit are you using? So try, if you do carry balances, to keep them under 1/3 at the time that you're pulling a credit score. In the past, it used to be that the credit score was literally in that moment. What was going on right now? They are changing those rules such that we will be looking more at the habits of the last couple of years. So it is a good habit to get into, is not extending, not having 1 card sitting there maxed out. I know that we have, mileage and reasons why we like to use 1 particular card, but it is good to spread that out. There's another reason which I'll get into in a second. If you have a collection and that happens, the medical ones are the worst ones. They tend to go fast to collection. It is good to pay it immediately, unless in that moment you're also looking to get a mortgage. Because if it's a 2-year-old collection and you find out about it and then you pay it, it actually becomes a current account and makes your score worse. So make sure you talk with your lender. If you find that you have a collection on your account when you're applying for a mortgage, make sure to talk to your lender at that time to see should you pay it or wait to pay it through escrow, which is an option. Again, medical can be the worst. They're fast. Once you do get rid of a medical, they should come off your report, though. So that's a good thing. That thing did change not that long ago. All right, trade lines. So I did kind of allude to this in terms of having multiple different accounts. In the jumbo market, so that non-conforming market, we look at depth of credit. In the conforming world, we just look at credit scores. So if your loan's only up to 510, we're really just looking at your score, that you have a credit score. In the jumbo market, we're looking for how much utilization have you done. And the perfect world is that you have at least 3 trade lines. A trade line could be a car, student loan, credit card. It could be 3 credit cards. It could be 3 car loans. It doesn't matter. Just 3 trade lines that are at least 2 years old and have had activity in the last year. That's the perfect world. We're looking for that. Once you've got that, we're done. There's no options that you don't have available to you. If you have less than that, there are options available to you, but they can limit you. And so just, know that if in the future you're thinking about buying a house, it's great to just pay attention. If you have an old card you haven't used in a while, put a tank of gas on it. Just bring it current. That's all we're looking for there. So that's credit depth. Keep the student loans. Student loans aren't necessarily bad unless you have a high interest rate. Save for your mortgage. Put your money into savings, and then come to us, and we can tell you, okay, now should we pay off the student loan or not? But talk to us before you do, because we would more often than not like you to have $20,000 in the bank and borrow $20,000 with a $300 payment. It probably works out better for you when you're looking to buy a house. All right, rental history is important. When you're buying a house, we look to see, well, have you paid your rent payments on time? Because it's a good indication that you'll pay us on time as a lender. And excuse me, if you're paying your roommate with Venmo, or every other month you're paying one roommate, the next roommate's paying, that gets very tricky, especially again in the jumbo market where we're more picky. So don't do that. Venmo I love it, but it is not easy to trace. So you're much better off to pay directly from your bank account as a bill pay, because you will get asked. Again, this is more appropriate for that jumbo market. And again, an auto loan, is it a good thing, lease or buy? That's a whole different conversation about, do you need a car and what kind of car it is? So I'm not going there with you. But in terms of a trade line, it's a good trade line. So especially for people who are new to the country, don't pay cash for your car. You want to build that credit depth, or even just people coming out of college. It's good to have the history. Even if you have the money in the account to pay it, just stick it aside and just get that loan, as long as the interest rate's low. Again, cost of money does come into this, but it is a good thing to pay attention to that. So that's credit and depth, and what we look at there. All right, moving on. So next thing that I had in the beginning was income. Okay, so there's different ways that we get income. Salary is easy. We just use it as soon as you receive it. New raise, if you get a new raise today, we count it immediately. If you've had a job gap, that is something to watch for. Again, this is a distinction that's slightly different in that jumbo world versus the conforming world, the small loans under 510 versus the bigger loans. But if you have had a job for longer than 6 months, on a conforming loan, we could ask you to be on your job for 6 months. And on a jumbo loan, we're probably going to go back and find out when you were working and want at least 2 years history of working. Commission and bonus, those are averaged. So these commissions and bonuses are what we call variable income. There's no guarantee. To us, a salary is a guarantee. So in order to use those towards your debt to income ratio, which I'll go through here in a little while, we're going to look at last 2 years. It's a good indication for us. If you've received it in the last 2 years, yeah, they're likely to get it going, and we average it. Just note that if your commission or your bonus is declining, which we've seen more of that this year because we are in 2020 and we've had some fun going on. So with bonuses perhaps being lower this year, we will use a 12-month average of the lower, or a 24-month average if it's increasing from year over year. RSU income, it's complicated. We do it. We use it as income. We have a funky calculation because there is, it's dependent on stock price. It's depending on how many shares you have going forward vesting. Super goober high level, we look at the last 2 years. What's the average stock price over the last 2 years? What's the current stock price? We take the lower of the two. And then we look at how many shares do you have vested in the last 2 years and how many do you have going forward? Again, we use the lower of the two. We average those, times them together, and come up with a number. So it doesn't match what you actually see on your paycheck or in your W-2 at the end of the year, but we can use it in qualifying. You do have to have a 2-year history, and most often than not, that means that you have to have been at your company for 3 years, because you more often than not take a year to vest, and then you start getting it. Some of the companies are different. They vest after 1 quarter, but again, call us. We'll go through that with you individually. All right, that was income. So moving on now to assets. So assets are your savings. It's what money you have to put towards the down payment. So that could be a savings account, stocks, mutual funds. 401ks we don't normally use as an asset for the down payment, although I'll talk about that in a second, but we do use it as reserves. So if you were with me on my my prior video talking about the distinction between conforming and jumbo, the larger loans look for reserves. We look for what do you have left over after the close of escrow in the event of a hardship that you could access. And we will actually ask you for proof that you can access it. Your companies will have a terms of hardship withdrawal on your website. So we'll look for that. So be prepared to get that. And basically, as I say, my little bullet point here, the biggest point is just have some of the above. When you want to buy a house, you have to have some of the above. We do have low down payment loans, FHA loans, which fall under that that fall under that conforming limits. However, they are government loans, which is different from a conventional loan. So they're actually backed by the government. That's Federal Housing Administration loans. They allow as little as 3.5% down, but generally you're probably going to want to look to get to 5% down and even up to 20% down. You have more options, and we'll talk about that later. But anyway, point is the practice is just save. So if you're very early on and you're not yet ready to buy a house, but you're looking to get your credit depth and you're looking to get yourself set up to buy a house in the future, savings is what you need to do. So again, going back to, should I pay off my student loans? I would rather see you have savings so that when you come to us, we can say, oh no, it's fine, pay off your student loan. We need you to get rid of that debt, versus you've paid off the student loan, we can't get it back again. So much better to have liquidity and have us have the ability to do something with it. All right. And using your 401k is important. Excuse me. All right, so I just talked a little bit about this again. So down payment can be as low as 3.5%. There's so many options here for 10% down, 20% down. This is the amount of, so if you have a $500,000 purchase, when we're talking about percentage down, that means how much cash you're coming in versus how much cash the loan is providing. So you'll often hear 20% is the magic number. It is. You have more options for lower rates and for paying less to the bank. But if you haven't gotten there, getting on the housing ladder is important. And if if you only have the 10% or even 3.5%, it's still a great way to get into housing. There are many benefits to owning a home other than just owning it. You have a tax benefit too. All right. So in addition to the down payment, we have closing costs. My guesstimate here is plan on 1.5%. This really varies. It varies on the county, varies on the state. Different states, different areas, different property taxes, different transfer taxes, different customs in terms of who pays for which. In a different video, I'll talk about escrow and what their function is, but a lot of this is determined by where you are in terms of what's customary for who to pay for which numbers in the closing costs. And then again, my little piggy bank there, that's my reserve. So I think I've already talked about that. Jumbo. Most loans require 6 months of the principal, interest, taxes, and insurance payment. Conforming, we're about 2 months, and most people's 401k or IRA covers enough of that. Just as a side note here, when we're looking at 401k and IRAs, we deduct 40% of what your balance is. So if you have 100,000 in your 401k, we actually only look at 60,000 as available for a hardship withdrawal, because we know that you'd have to pay taxes and a penalty if you did have to access them for a hardship. Okay, more fun. So you've heard me talk about debt to income ratio and mortgage payments. So your mortgage payment comprises of the principal and the interest payment. That is your mortgage payment. Taxes and insurance are two other things that are required to be paid. Taxes are paid to the county. Insurance is paid to an insurance company. We as a lender want to make sure that you always have your property taxes paid, because that is a lien that is in priority to us as a lender. So if you defaulted under terms of the loan, we actually would have to pay the property taxes if you hadn't paid those before we would be allowed to get paid. So we care about getting paid back, and we want to make sure your taxes are current. So when we're doing any calculations, we take this PITI, principal and interest, taxes and insurance, and we know that you have to pay those. Now, we also know that you have electricity and gas, and you have, food and other fun things that you need to do, maybe daycare for your kids. That is not part of our calculation, in that we've already taken into account. So we have a perfect number that we say you need to be under when we're talking about this debt to income ratio. And we've taken into account the fact that most people need probably about 60% of their income left over, their gross income left over, for all this other stuff, including income taxes. So, okay, so the math is PITI, principal, interest, tax, and insurance, divided by your income. That's what we call the housing ratio. We don't tend to look at that. In the olden days, we used to split these two out and really focus on the two, but they can both be about the same now. There's no distinction. So the other ratio is the principal, interest, taxes, and insurance, plus your other debt. That's your car loan, student loan, credit card minimum payments, any other debt, alimony, child support, anything else. And then we divide that by, again, your gross monthly income, not net, but your gross. That's where we call the debt to income ratio. And in a perfect world, in most cases, we want that to be under 43. In those conforming loans, again, I'm talking again about the smaller loans, we can go higher. We can actually go up to, in some cases, 49%. And we do have some jumbo loans that allow me to go higher. They're more creative loans that are what we call a portfolio loan, non-saleable, sits on our books as a lender, that allow that debt to income ratio to go higher. But generically, we're looking for about 43% of your income to go towards the house payment, or the total debt payments. All right, so here's a quick example for you. How does that work out in the math? So if we have $100,000 in income, that's $8,333 a month. If we buy a $500,000 home with 20% down, again, that's 20% of 500, is $100,000. The principal and interest payment is $1,852. The taxes, 1.25% of $520. Now that is very specific to a Northern California home. In different areas, that property taxes is different. As an industry, we tend to default to 1.25%, no matter where you are. But in some cases, because it's lower, we can actually use the lower number in the calculation. Insurance, I didn't go into too much detail on the last slide, but insurance is your fire insurance. In the event of a fire, we know you're not going to come up with $400,000 to pay us back. So we're going to say, you know what, we need insurance just in case the house burns down, because it's our collateral, it's our house. In some cases, you'll have homeowners dues. Those are the association dues for a condo. When you own a house in common with other people, you have to have common insurance. You maybe have a common pool. That's the homeowners association dues. So not on every house. That's only on a condominium ownership. And in some cases, you might have mortgage insurance if you would put less than 20% down, just as a note. And we'll go over that later. So PITI plus your student loan plus your auto. PITI plus other debt is the 3572. We take 3572 divided by the 8333, and guess what? That came to 42.9. Not that I planned that, but I did. So that's the debt to income ratio. That's the magical number. And we do a lot of loans where people are at 42.999. So it's doable as long as we're under that level. All right, so let's reverse that. Well, what income do I need if I wanted to buy $1 million home? Just as an example, and obviously that's a lot in some areas and not much in some. So again, just backing into it, $1 million home, $200,000 down payment is your 20% down. Principal and interest, $3,704. Taxes, $1,041. Insurance, homeowners dues. And then we take the student loans and the auto again. So we got 5,945 is our principal, interest, taxes, and insurance plus other debt, divided by what is 43%. And that magical number is $165,000 a year. So if you have $200,000 saved and some in reserves, remember, 6 months times that PITI is what you're really going to be looking at. So somewhere around 35,000-ish, top of my head there, in reserves, and $165,000 income. You can buy $1 million home. Great. All right. So I did mention very briefly mortgage insurance. So mortgage insurance is when you put less than 20% down, because we as a lender want to make sure that if we went into foreclosure that we would be paid back. If you put less than 20% down, there's a chance that we wouldn't get paid back. There's a chance that the market's changed. There's a chance that maybe the houses need some fixing up. So as the industry, we say we need to put an insurance premium on in addition to your fire insurance that covers us in the event of default. And that's all that mortgage insurance is. So there is a way to avoid mortgage insurance where we do a second loan. So you might hear of it, it's called piggyback. We take the first loan. This is in the conforming world. This is in those smaller loan world, mostly. Not always, but mostly. We take that first loan and then we do a second loan. We call it second because it's actually in second position. It sits behind the first loan in order of priority. So in event of a foreclosure, the first loan gets paid first, the second loan gets paid second. So we use second loans to avoid mortgage insurance. The nice thing is you get rid of it as soon as you pay it off. So whereas mortgage insurance stays, no matter what your equity is, you have to fight to get it off after 2 years. There's some rules. But with the second loans, as soon as you pay it off, it's gone. They're normally equity lines, which means that they can stay open. So let's say you pay it off and then you say, hey, I need a new roof. You can use it again in the future. So second loans are great. I actually advise most people to put a second loan on their home, even if you don't need it. It's much better to ask for money when you don't need it, because when you do, you might not qualify. So let's say you lose your job, but you have a second mortgage, you have an equity line on your house. It's a great thing to just have that. It's an insurance policy for you. So we can talk about that individually because, of course, you have to qualify. The highest loan to value that a second loan will go to with us is 90%. It's actually 89.9. The industry right now is more sitting closer to 80% loan to value because of COVID. So we had a lot of tightening in our rules there. All right. So on a $500,000 price with a $400,000 loan, we would do a $50,000 second loan, and that avoids the mortgage insurance. So that's the math there. All right. So that's it for me today. I could talk forever about all of this. I love to educate. I love to help you with this. So don't hesitate to reach out to me. You see my information in the banner there if you have any questions. And happy house hunting, happy lending. The best thing to start with is get qualified for a mortgage. Don't go looking for a house first. You need to know what's in your pocketbook. And start early. Start years before you think you're going to do it. I love to help you set yourself up to buy a house in the future. It might not be today, but if we can work on that credit depth today or the savings today, it gives us so many more opportunities in the future. All right. Well, lovely to have you join me here. Again, Nikki James, and I look forward to seeing you on my next video.